From the morning reading, large caps roll over short term. The S&P 500 leads the market lower over the last 3 weeks with a decline below 209. This is still a rather modest decline because the ETF is still less than 3% from the all-time high. Hesitant to call the 207, 208 area major support level because there's a lot of support in the 204, 205 from the March lows. Let's take a look at that chart. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices from investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of the current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:46 a.m. Central Time, and I'm recording this in preparation for market day, June the 10th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just what we're dealing with. As I mentioned from the morning reading, the S&P has come into some pretty significant support areas, but there's more support not far behind. So I mentioned the support in the 207, 208 area. So this is the bottoms here. Let's dial this in a little bit. So these swing bottoms that you recently had, but there's also significant support right here in this 204, 205 area. So, with a 3% pullback, and of course this looks ugly, it basically seems to be a March almost relenting with only really one exceptional day in between. This was the day after the holiday, the first day that everybody came back. You had all market participants, and they summarily rejected the recent high. But then the bulls came back in and just overwhelmed that pattern, taking it back up. But that had no staying power, and every single day since then basically has been down, which puts us at down 3% from the recent highs. You have support, more support, so this doesn't look and feel like it's going to become something really, really large, but certainly, guessing bottoms is always a fool's game. Bottom line is you've got a situation where the indices in general are near the bottoms of their recent ranges. And there are some differences. Obviously, the Russell, that pattern looks a little different. It had so much more weakness earlier, but they came back and now seems to be in kind of a new range of the last couple of weeks. NDX, along with the Russell, we need to have growth and leadership out of these two sector, I should say indices, if we're going to have a strong, healthy bull market. Well, that certainly doesn't look healthy for the bulls on the NASDAQ. And then, of course, there is the Dow Jones, which, much like the S&P, looks to be right near the key support areas. And indeed, it kind of played with those recent supports around the 177 area, but there's also more support not far away at the 175 and change area. So coming into quite a zone of support across the indices. Right now, the ES, which is the S&P's futures contract, seems to be gapping up, and if we open more than 8 points up from yesterday's close at the open, and we still have ways to go. It's 6:49 a.m. Central Time. If between now and 8:30 Central, when the cash market opens, this continues with this trend. And here's the 5-minute. If we hold up and we end up about 8 points or greater, it could be one of those gap and go situations. But you see right now things seem to be fading back. So we'll have to wait and see how this shakes out at the open. But overnight action is relatively bullish. In fact, let's go ahead and jump into our overnights. All four broad market indices at the time of this cut were up about 1/3%. You have crude oil up 1.75%, euro essentially flat, bonds down about 0.82%. Bonds continue to just get hammered, and then gold up about 0.84%. Had a discussion with a number of traders yesterday and asked the question, if we were to have a significant pullback in the broad market, would TLT and the long bond, would it be a safe haven? Would it go up? Or because of the unwinding of the bonds, because of the anticipation of Fed rate hikes, would that not be safe haven? And if not, where would cash go? Where would that run for security and safe haven go? So don't know the answer to the question. We weren't able, obviously, to satisfy the crystal ball as to what that might be, but it's something certainly to watch if we do have more weakness come out of this recent pullback towards the bottom of the range. If we do get something that accelerates and starts a bigger, more significant move, what will happen in that movement from the stocks and equities into bonds? Will that happen? And if so, will it go to TLT in the long bond, or does it do something else? Gold here was up on the overnight, but gold hasn't seemingly been much of a safe haven status of late. So you've had this kind of breakdown of traditional correlations, but is it a breakdown only in the face of lack of fear, or is it still the safe haven status if there's true fear in the marketplace? In overseas action, China down about 0.15%. More significantly, Hong Kong down about 1.12%. Japan down about 1/4%. Europe rebounds. You got Germany up about 0.78%, followed by the United Kingdom up about 0.4%. In terms of macroeconomic reports for today, of course, you got the typical crude oil inventory at about 9:30 Central Time. There is a 10-year bond auction, and normally that's a yellow flag report, but given the sensitivity to interest rates, that probably will be followed a little bit more closely than is typical. And that should be about it for today on the U.S. side. In terms of coming action for tomorrow, we have core retail sales, unemployment claims, the weekly variety, and a 30-year bond auction. And again, much like what I just mentioned with the 10, probably following these bond auctions pretty closely right now in the current environment. So that might be more important than the yellow flag invokes. In terms of current volatility, pretty quiet yesterday all in all. No standard deviation moves were put in by any of the four broad market indices. And you see the implied IV percentiles 28, 19, 32, 43. Nothing terribly exciting there. Short-term VIX 15.05. So obviously higher than some of the levels that we've had of recent. I think we popped below 10 at one point. So as a percentage basis, increase, but this is certainly nothing to get terribly excited about. The VIX is within its normal trading range. In terms of our regular daily report, big picture, we're still intermediate term phase 3, higher highs, higher lows, just a lot of range bound activity. There are warnings, though. While the IBD status is confirmed uptrend, GMI index is a 4 out of 6, so not perfect there. More concerning is the market posture, which is actually very bearish. You have S&P at only a 36.7. Dow is actually even lower to 23. NASDAQ has turned bearish at a 70.9, and the Russell has also turned bearish at a 69.4. So quite a bit of market posture concern coming in. Other levels that we look at in making up this overall opinion of our hedge warning status risk level, which is currently a 0+, normal with cautionary aspects, is fairly clean. We have this VIX daily squeeze still present. We still have a distribution day count at 4 and 4, so right at the threshold of being something perhaps more serious. You have new highs, new lows, certainly very, very high count on the new lows yesterday, 474, and you have 2 of the 5 risk aversion indicators having flagged as risk off. So there definitely are concerns. Most importantly, the concerns come from the number of new lows and the fact that we have this market posture, which is pretty ugly right now. Might be setting up for at least a short-term bounce. We'll have to see, based on patterns yesterday and so forth, and the overnight action could be setting up for something of a bounce today, but that may still fade. Our regular special opinions, option income strategies, no change here. VIX is inside the acceptable window. Covered call strategies, looking for a 3-to-2 distribution between in the money and out of the money strikes, and put selling is acceptable in this market environment, but consider the position size that you are willing to own and selling puts on stocks that you are willing to own. So put credit spreads with defined risks and scaling into positions until the market has confirmed a breakout certainly would be an enhancement to that risk management. In terms of our sector-specific market posture, a sea of red on the short to intermediate term, no healthy sectors. So that certainly is a warning sign. In terms of percent change yesterday, you see the winners. And really 4 of these we'll call scratch. Really only financials and consumer staples putting in a solid day yesterday. But you see, when you look back, and it's always good to have perspective, not just what happened yesterday, but what are the trends in the 5-day, 1 month, 3 month. There are not a lot of healthy sectors. There's nobody who's green across all those time frames. So very difficult to be a bull right now. So I think that's probably enough for today. If you find this is helpful, we appreciate you liking us on YouTube. If you came here from Twitter, we appreciate you retweeting us to your followers. If you have email support that you would like to give us some feedback on, support@falconglobaltraders.com is the email address. More information about what we do and actually taking this kind of information and applying it to our daily trading may be found at this website. Performance matters. We get it, and we're transparent. Disclaimers, as always. Hit the pause button if you need more time to review the disclaimers. And we'll look forward to seeing you back here before the market opens with tomorrow's market preview.